Hi, this is Cindy Moss, and I'm going to give you just a quick overview of Chapter 5 and 6 that you're going to be studying for next week. Sorry I haven't gotten it to you a little earlier, but this week's been advisement, so it's been a little hectic, and so I'm just now getting around to recording it. In Chapter 5, this is one of, in my opinion, one of our most important chapters, especially for you that are younger Reinhardt students. You that are married and have children probably have already experienced this. But this chapter is basically talking about consumer credit, the advantages and the disadvantages of consumer credit. This would be that you have credit cards, debit cards, different things on that age where you're not paying cash for purchases. So we're going to start with the objectives of the chapter, which is, again, analyzing the advantages and disadvantages of consumer credit. And, of course, some of the advantages is that you can buy now, pay later for major purchases. And then you are establishing some credit. Even as young Reinhardt graduates, you're going to have to establish credits and have a good credit rating in order to buy a house. You need good credit ratings for job interviews. Believe it or not, they do check your credit ratings. Of course, then some of the disadvantages of consumer credit is that we tend to overbuy because we're buying now and paying later, and then it ties up capital that we might need at a later time and date. So as you're thinking about consumer credit, always keep in mind that you do want to have and to be able to use credit, but we do not want to abuse it. And then you're going to look at the different types of consumer credit, which are closed-end and open-end credit, and then where you're going to get some credit ratings from. You're going to get them from banks or credit unions. You can get them from stores such as Macy's and any of Sears, any of those major discount stores, Target. They have their own credit cards that you can do. And then, of course, you can borrow money from family, which, of course, I do not agree with because it does tend to sometimes result in hardship in family feelings. And then you want to determine whether or not you can actually afford a loan. And there are two general rules for looking at that. And you want to look at those, the debt payment to income ratio and the debt to equity ratio that you're going to look at in this chapter. So make sure that you can afford a loan, that you don't overbuy. One thing when my husband and I were younger and we were getting started, one thing that we always did, and it really saved us a lot of heartache in the long run, was we always waited 24 hours before making a major purchase. So I'm not talking about whether or not we went to the grocery store and bought a loaf of bread, but I'm talking about cars and furniture and big TVs and things like that. If we saw something we liked and we just thought, I can't live without this, we always made it a priority in our household that we went home and we waited at least 24 hours before we made that purchase. Most of the time when we got home and we thought about it, then we'd say, we don't really need it. And it really saved us a lot of heartache as young married people, and even in our 30s, we just never overspent because we had that in place in our marriage. Another thing is that you want to determine the cost of your credit. You always want to look at your interest rate. Look at your credit cards that you have now. What is the interest rate? The last time I checked a credit card, I think interest rates were anywhere from 18 to 24%. I don't say not have a credit card. I have credit cards, but we always pay them off at the end of the month. That if you can do that, then there's not a problem using credit cards. But if you're paying interest on top of your monthly payment, you're not ever going to catch up. So make sure that you do that. And finally, in this chapter, you're going to develop a plan for protecting your credit rating and then to manage your debts. You always want to have a great credit rating. When you fall below 500, then it begins to affect what you can purchase. Again, it protects job interviews, different things like that. So you want to make sure that you protect that credit rating, and you want to manage your debts. I know that just about everyone in the world has had credit card debt. Don't let it overwhelm you. Don't buy on impulse again. Make sure that you have to have that it's something you can't live without. Debit cards are, again, they're a great way to be able to purchase things without actually having to have cash. But the great thing about debit cards is it comes straight out of your banking account, so it's not going to let you overbuy on that. So you do want to look at those things when you're thinking about it. What if you have a bad credit score? How can the chapter goes into how you can improve your credit score? So that's something you want to make sure that you look at. Improve your credit score, keep your credit score high, and it will make your life a lot easier. That is just a basic overview of chapter 5. I hope you enjoy it. It's one of my favorite chapters is chapter 5, and then the next one is chapter 6. Again, is another chapter that I enjoy because I think it affects our students and it helps them prepare for the future. So for chapter 5, you're going to have you're going to have a Learn Smart, a quiz. You're going to have 2 video questions that you have to watch and answer, and you also have a discussion board for this week. So have a great week. Hope you enjoy these 2 chapters.